All right, we're on.
Yes.
Okay, everyone, ready? Grab a chair. We have a few left. Back in the back. For the front. It's front and center right here. We got seating. All right, let's get started. We have a lot of pitches to get through today, so we might as well get ourselves started. Welcome to the AIM Class 2023 Fall 22. Board date October 7th. We've got 8 pitches we're going to be handling today. I'm excited to say in the history of the AIM program, this is going to be the first time we have a number of sells and holds that we're pitching. While we can't short anything in the portfolio, we certainly can sell things. And so as a result of that, what we've done is we've managed to find some market inefficiencies where the market may be missing something that it's not exactly a buy at all. So I'm pretty excited to see that we have a mixture of buys, sells, and holds. That's a new thing for us, but like I said, we are very focused on departures from what the sell side is missing, and I think we've got a nice variety for those folks viewing in person and at home. So without further ado, Max, come on up and walk us through how you landed on Synaptics, I can't speak today, as well as, kind of any quick cleanup questions, and then we'll hit the floor running. Thank you.
Alrighty, hi everyone. Max Kruszeski. I'm pitching Synaptics Inc. with a price target of $154.28, representing a 43.61% upside. Just kind of to start, to give a brief overview of what the company does. Synaptics is a leading worldwide developer and supplier of premium mixed signals fabless semiconductor solutions. The original equipment manufacturers, or OEMs as I refer to them as, our customers include many of the world's largest companies for smart devices, automotive solutions, notebook computers and peripherals, smartphones and tablets, and audio and video products. Some of their main OEMs include Microsoft, Oculus, Acer, Dell, Ford, Samsung, Sony, Toyota, and Google. How I landed on this company, I started with a FinViz screener of tech stocks in the United States, anywhere between small to mid-cap, or mid-market cap, no dividend yield, price above top $5, price of free cash flow above 5, positive ROE and EPS growth this year and next year. And then I kind of narrow that down based off the industry of the tech sector, that based off trends and personal opinion. Prior to this, I pitched 2 software companies, so I kind of wanted to switch it up, and I went with semiconductor. So I'll open the floor for questions.
Questions from the crowd? All right, Dr. Valentine will lead us away.
Sure.
I think you're using free cash flow per share for your basis for valuation, right?
Correct.
So where is it on in your report, the free cash flow per share?
In my report, that is in the valuation section. Finally,
It's in the appendix? Or
oh no, it's not in the appendix.
the box?
The price of free cash flow ratio is in the peer valuation boxes. I did not include the actual specific 2022 free cash flow for Synaptics. I have that number right here, and it is 432 million.
What's it on a per share basis?
Uh,
I'm trying to, because your valuation talks about on a free cash flow per share, so I'm trying to understand what that number is.
let's see here.
Here's a good hint for folks while he's looking. His price
10.9.
divided by free cash flow is 12.1. You know price free cash flow, you should be able to kind of estimate what 12 times are. But yeah.
So I think it's $11.
Yeah, it's about 10.9.
Back into it.
Yep.
So how does the $11 compare to consensus? What is the consensus free cash flow?
Free cash flow for consensus was a little bit lower. It started higher, and then it's forecasted out to be a little bit lower in the coming years. I think that kind of has to do partially because of the recent acquisitions that Synaptics has made in 2020, 2021. That's kind of driven that up. Because of that, I think that the price as a result has gone up, leaving free cash flow where it was. And I think that when that stock kind of shot up in December, I believe it was, of 2021, I think that, I don't want to say it was a hoax, but I think it was kind of, there was a lot of momentum, and I think that was also right as when they came out with their 10K statement that they beat earnings. So I think that the recent acquisitions beating earnings kind of drove that price up and kind of,
Okay, so
in my opinion, changed.
That's good, but
Yeah.
that's not really what I'm asking. I'm just trying to get real simple on free cash flow per share. You're saying it's $11. Is that for calendar 2023? Or is it the next 12 months?
That's 2022. The
2022.
trail, yeah.
Trailing.
Yep, because I used the 2022 number of free cash flow.
Okay. So what is the stock trading at on forward, or either next 12 months or next year, or if you want to go to 2024? What's it trading at on future free cash flow per share?
I don't have that number on me right now. I can look into that and get back to you.
So if we look at, okay, that's fine. So if we look at the comps that you're using, when you look at free cash flow per share, which is, I think it's on page 3 of your report.
Yep, last page.
So you're coming up with 13.2, and which is above where it is right now. Although the 12.1 you're saying for your stock is a trailing number?
Yes.
Okay. And why would you use trailing as opposed to forward?
To be honest with you, that's the number I grabbed from FactSet.
Okay. And so you have another company here called Diodes Inc. That's at 25.5 times, so it's more than double the multiple. So why are you comfortable using a company with such a higher multiple?
Because I think that Diodes has a good basis for Internet of Things semiconductor solutions, similar to Synaptics. I think they're at a further stage ahead in terms of what they're doing. But I think that I included them there because I think Synaptics has the ability to replicate what they're doing, if not better. I think it's going to take a little bit of time, but Synaptics has just recently made this push for Internet of Things and the products and the solutions that they're coming up with. Diodes has been at it for a couple of years now, and I think that with Synaptics, maybe it won't get to the 25.5. I do think that that's a little high, and I don't think it's realistic for me to assume that it gets to the 25.5. But I do think that Diodes is an example of the potential Synaptics has to increase price free cash flow.
So if you think Synaptics has a lot of upside, why would you use HP that has a 7.5 times?
I was looking at companies that have struggled recently. There's something that we had talked about, looking at growth rates in the trailing anywhere from 3 to 5 months because of the fact that Synaptics has slid a little bit recently, and I think HP has as well. HP is also one of Synaptics' competitors in the IoT semiconductor space, so that's also why I decided to include them there.
Questions from the audience? Yes, Joe.
Regarding your Wi-Fi 6, what's the current coverage? It says mostly for the corporations and stuff. Where's the current coverage of that? Is it mainly the East Coast, West Coast, and what are the plans for like expansion of that, or how they're going to get that to everyone?
In terms of a specific range of coverage or where percentage of the United States that it's covering, I don't have that number. I looked a lot into finding a specific number from your question last night. I do think that it's relatively easy to expand. There are routers out there now with Wi-Fi 6 capabilities. The new iPhone, Galaxy phones all have Wi-Fi 6 capabilities and are ready to use if a Wi-Fi 6 router is presented. So for instance, if we wanted to get a Wi-Fi 6 router for the AIM room, we could. And anyone with the newest iPhone or Galaxy could have Wi-Fi 6 capabilities. In terms of how it is to expand, like I mentioned in my question to you last night, I think it's a matter of time. Wi-Fi 6 isn't considered the norm yet. It's expected to become the norm by, I think, the end of 2023, they said in my research. So I think that coverage will begin to expand in terms of how easy it is. I don't see them having any issues with considering how they did it with Wi-Fi 5.
Question in the back? Or no? See. All right. Can you walk me through what's your cost of equity?
My cost of equity is 14%.
Okay. What's your cost of debt?
20%. All right. Sorry. Cost of debt is 5.62.
Okay. And can you tell me what the market cap of the company is?
4 billion, or excuse me, 4,037 million, 4 billion.
So about 4 billion.
Yep.
How much debt do they have?
True total debt is 1 billion. Roughly.
So they have 4 billion in equity out of 5 billion in total capitalization and 1 billion in debt, right?
Yeah.
So they're actually 80% equity, 20% debt. And yet in your WACC, I'm assuming you use the debt to equity ratio of 80-20 debt, which is bringing your WACC down, which would make sense, except the math, the basic numbers aren't adding up for me.
Okay.
I think you got your 80-20 reversed.
I may, and I will look into that. And,
So I'd like to know
yeah.
in sensitivity, right? If we
Yep.
take the 80-20 and flip it, the WAC is probably going to be pushing 13 based on the numbers you just gave me.
Okay.
I'd like to know what that does to the value.
Yeah, I
this year.
have WAC at 12.3, but I had that weighted with FactSet WAC 9.15.
You got WAC on your right up to 10.72.
Yep, right there. That was the average between what I calculated.
Why are
and FactSet.
you using other people's work to use a WAC? Like, okay, let's pivot gears. You calculate the WAC to be 12.72.
Sure.
I appreciate that.
Mhm.
Why are you bringing FactSet into play? Who did you follow? Which analyst? What did you do to replicate their work? I'm not Jim. I don't trust other people.
Okay.
I'm a hedge fund guy.
What I included an equity risk premium in my WAC calculation.
But I mean, I'm a trust but verify guy, right? I'm good with the street, but I want to know what you did. Like,
Yeah.
why should I trust FactSet? And I don't trust them at all based on this 80-20 split. I got 80% equity. I don't trust those analysts at 9% whatsoever. So
Okay,
help me understand why you do.
Yeah, so what I did is I included an equity risk premium in my,
now it's getting
international,
worse.
what?
Well, now it's getting worse. You included a risk premium.
Yeah.
What's your risk premium?
3%,
Okay, so what's your final WAC? Let's do math together.
12 point, what I calculated
Yeah,
or what I.
with
was-
your risk premium included.
12.29%.
All right, so let's just call it 12. Let's
Sure.
keep math simple.
Okay.
If your WAC is 12 and I subtract your 300 basis points, you get a WAC of 9.
Yeah.
Which is about the same as FactSet.
Okay.
Great, except you're 80% equity. And your equity, cost of equity is how high? 14, right?
Yes.
There's a beta of 1.9.
Yeah, so if my cost of equity is 14 and I weight that 80%, what's 0.8 times 14?
Roughly 12.
Yeah, so I'm gonna take 12 plus before I add my 300 basis points, I'm already gonna be up about 13% WAC.
Yeah.
I'm way off. I'm gonna go back to my original point. Please adjust your WAC.
Okay.
And tell me what the actual output of your DCF will become as a result of doing so. I think your real WAC is gonna end up being like, if you throw 300 basis points in, I didn't know you did that, it's gonna be like 16 or something.
Yeah. Okay, I will
Thanks.
adjust that. Yeah.
When I do look at FactSet, it shows the consensus EPS estimates, forward-looking, back in January, were $14 a share, and now they're only $12.70 a share.
Mhm.
Why have analysts been lowering their estimates so far this year?
I think that would have more so to do with the macro factor and the company's still adjusting into its Internet of Things potential. I think that sales in terms of from 2021 to 2022 kind of flatlined. Excuse me, from 2020 to 2021 flatlined and increased again in 2022. Consensus has them kind of flatlining again. So year over year from 2021 to 2022 was 30% increase in sales. Consensus has that now down around, I believe, 5% for 2022.
I guess I'm trying to
2023.
understand fundamentally because when you see the analysts taking down their estimates, especially for a company like this, it usually means something bad's happening or there's a disappointment. So I'm trying to understand what's been disappointing about the company that's leading the analysts take down their forward-looking estimates.
I think that if I had to point to something, it would be the fact that they anticipated more margin expansion from the divestitures that I had discussed. And from the last year, I started looking at quarter by quarter, and I didn't see the margin expansion that I presume everyone was expecting. Through my sell-side research, I never saw anything in particular that they're like, this is why they lowered estimates. However,
So
I have
you're
to,
saying the analysts been lowering estimates all, well, I'm saying analysts have been lowering all estimates all year, but you're saying they're not writing about it.
well, they are writing about the fact that they want to expand margins in that regard of they want things to become cheaper because of the fact that they're getting rid of some of their less successful product segments, but I just haven't seen the margin expansion that I believe was predicted. So I think that's why they haven't been, but
So it sounds like they're falling short of improving their margins.
correct.
Okay. Why do you think going forward, we're going to put this in the portfolio,
Sure.
we want to know why do you think he's falling short for the last 9 months is now going to stop falling short?
In my opinion, management has done a great job since they came into office in 2019 of bringing the company to newer places. Obviously, lowering estimates is not something that we want to see. However, I do have confidence in management's ability to bring the company within its IoT space, which they're investing all of most of their time into now. That, along with other strategic acquisitions, they've made 3 since they came into office in 2019. So I think that coupled with the IoT push, Wi-Fi 6 adoption and whatnot, will be able to allow them to increase top line sales and also kind of catch their rhythm in terms of operating without those divested segments.
All right, you got through the ringer, since you got put through the ringer by the 2 of us.
Yeah.
Let's give you a layup. I hope. I don't know
Sure.
what it is. In all of your write-ups now, we're kind of hoping you did something that no one can see, right? I'd like to see it in an appendix. We didn't have that happen in all the write-ups, but I'm rather hoping you did something kind of outside the box in your approach to diverge from the street.
Yeah.
We've included it in the writing. Can you tell us what that is and what makes you unique? That'll be different than everybody else that we read from the street.
Yeah, I estimate that the IoT push from Synaptics will drive top line revenue 3% higher than consensus estimates in fiscal year 2023 and 11% higher in
And how
fiscal year
come?
2024.
That's great. How come you believe that? I'm trying to give you.
Yeah, so Synaptics has invested a ton of money, roughly anywhere from, where's the number here? 65 to 75% of total operating expense in R&D. They're getting a lot, gaining
that's
momentum.
a lot higher than they used to, and you don't think the analysts are catching that yet?
No, I think that historically that's the number they've had.
Yeah.
And I think that's set to increase because of the fact that with the Broadcom deal, they acquired 2 undisclosed product maps that they have yet to release, something that the street has talked about that came in the acquisition notes, the details, but they haven't seen what it was. I think that these 2 items have potential to bring Synaptics a little bit further in their IoT push, and they're also with the R&D, being that Oculus is one of their main OEMs. They have invested money to get into the VR metaverse chip space in that regard as well.
Thank you. Appreciate it. All right, Danny, come on up and walk us through Rexford. Same idea. If you could tell us how you came upon the company, what you're pitching us, and then maybe you can answer it now, or I'll make it your nice cleanup question if you want a nice go away. What your differentiator is that the street is missing. I think we should just kind of pitch that way going forward. Yeah.
Great. Hi, everyone. So today I'm presenting Rexford Industrial Realty. So how I came about this company really was I was looking for obviously strong earnings growth for the real estate sector, specifically related to REITs. And in today's environment, I was trying to find an asset class that I thought could be sustainable. So I kind of landed on industrial and really just started with strong earnings growth forecasted for the next 12 months and the year 2 after that. So I found Rexford EPS growth, or FFO growth, I should say. FFO is basically the EPS metric for a REIT. It's just a different asset class. It's a different valuation metric. So think of it like EPS. For the next 12 months, they have forecasted 10% earnings growth, which is pretty in line with a lot of my
FFO stand for?
funds from operations.
Yeah.
Thank you.
No, you're doing great.
We always
When we do a REIT, right, this is a real estate investment trust. I like to have it be a teaching moment too, so thanks for helping us. Yeah.
So then to go off that, the following year in year 2, they had 14% FFO growth. I'm sorry, I have those reversed. Year 1, 14% FFO per share growth, followed by year 2, 10%. And in year 2, that was well and above a lot of my industrial competitors, I noticed. And that derived a lot from their market focus in Southern California. All 340 of their properties are located in the Southern California markets, which is experiencing one of the highest demanded industrial markets in the U.S. today. Record low vacancies of around 1.5%, which is really driving up demand and allowing landlords, in this case Rexford, to drive up leasing spreads and rent escalators. So I really dove in, and obviously if you read my write-up, I came to a hold rating. And my pause really comes from my valuation rather than the fundamentals I kind of just mentioned. my fair valuation comes from the immense premium they trade at to the U.S. real estate index. It's at 53% right now. And FFO per share forecasts have actually been kind of leveling off, declining in the recent months, but stock price through the midway point of the year was plummeted up. So it was kind of an inverse relationship, creating a really, really immense premium that I mentioned. So my forecast of FFO per share for 2022 is actually under consensus by 2.5%, which I think we'll start to see the decrease in that premium to more historic levels.
So they're being too aggressive. The street's being a bit too aggressive. Is that what you're thinking?
Well, the street is actually lowering their estimates, which is interesting, and the stock price took, in about June and May, took a shot up. Was trading at an even higher premium than it is now to that 50%. So I think investors have been overpaying for those future cash flows based on those mark-to-market leasing spreads that they can bump up, which I feel like might have been already estimated in consensus forecast.
Why do you think that people are thinking that they're not worried about the street moving numbers down? Do they feel like inflation's just going to take care of rents? Do you have any guess?
Yeah, so I think
Sorry to interrupt your flow.
No, that's good. That was kind of leading to my point. I think my thesis on that is that a lot of investors see the market fundamentals of the Southern California region. Their rent escalators are 4.5% this year, which is 2.5% higher than normal CPI adjustments. So I think people are seeing that and taking that into consideration how this company focuses solely on this market, which is such a huge advantage compared to a lot of competitors right now who only operate around 16% in that region. But I feel like they're not taking into consideration the higher costs of capital with rising debt and equity.
Potential risk that things return.
Well, there's that, and I think the other thing that really impressed me with your work was that you said only like 15% of their contracts are even renewable over the next year. I think it was like 12% the next year, or vice versa.
Right.
So for somebody who's just on a computer scanning reads and saying, I'm in Southern California, oh, this is going to be great. I think you took a pause. You're like, yeah, but you can't roll over all the business over the next 12 months.
Right.
Can you walk us through
Yeah,
that?
so to get into that point, so they've been an active player in acquisitions. They've done over $2 billion this year with an additional $200 million coming in. But related to their internal operations, their existing leases, in the next 12 months, they have 13% expiring, and then the following year, 15%. So that's less than a third of their business, internal business that exists today, rolling over. And yes, they will be able to drive in the landlord's market with low vacancy. These tenants really don't have many options to go to. They're able to push up rents. However, as this inflationary environment affects the cost of capital for the company, it also affects tenants and their ability to pay rent. So their retention rate, which is basically just returning tenants coming back, has fallen year over year about 5%, 6%, I believe. So really internal growth is dropping, although the rent escalators are going up and the leasing spreads are going up. Internal growth is really not material. And as I kind of pointed out to these acquisitions, a lot of these are still in lease up and they're still in redevelopment with the cost of construction is also going up. So until they can lease those up and push those leasing spreads, their internal and external growth is kind of still down the line.
That's awesome. Just for everybody in the room, this is a kind of a coachable moment where you'll get the general uneducated people out there in the street that they're analysts. They'll go and they'll see a company, they'll try to connect dots. This trend's happening, I'm going to buy a company with exposure to it, without realizing that 75% of this company's business isn't going to be renewed until 2024, 2025. So when you start to see that the market's priced too much into it, you can do things like Andy's done here.
Joe.
You might have just answered it a little bit, but do you have right now at your holds, do you have a trigger event that would initiate a sell or a buy? Like if this event happened that you would change?
Yeah, that's a good question. I think to trigger a sell, again, my pause kind of comes from my valuation rather than the current fundamentals, but their yields on these acquisition and investment, which is just return on investment basically, which is exemplified by their implied cap rate in my peer boxes. It is low, it's at about 3.8%. And you can think of the applied cap rate as just return on invested capital. So it is lower than a lot of my peers, which isn't necessarily bad. It kind of translates to less risk in these investments, but it's going to take more time to get the returns on the initial investment. So their initial yields on these investments are around 3 to 4%, which is much lower than the market norm. So I think to get a sell, these yields would have to go up to kind of more normal market conditions around 5 to 6%. And to do that, it's very possible with my market fundamentals I just mentioned, they're able to drive up these rental rates, and they've been growing a lot. But in this environment with the high cost of capital, especially how they're weighted with majority equity, it's just too high. And although possible, I think the yields really is what drives the sell in this position.
So I appreciate you doing a read. These are tough. We don't see them often in the program. Only double majors in real estate we tend to assign this sector and do them. And so I appreciate the work that goes into doing something like this. Even, we don't always end up in buys and everything. What I hope would happen, I have one question and then a commentary. Did you do an NAV model by chance?
I did not do that.
Okay, so in REIT, sometimes we do something called an FFO or an AFFO model and an NAV model. And that's something I'm happy to work on over time. But what I'd love to see, we're almost there, because you guys are all answering the question great, right? First pitch we saw it, second pitch we saw it. What's different here? We went ahead and modeled out the percentage of when all these leases are coming due and the probabilities of failures and things. And if you made a table in your appendix and showed that off, I would follow you. Like, this is the stuff I follow analysts for. This is really good. And the work you did, I respect. When I see that extra piece, I go, I got a guy who's really put the extra part in, and you did it. The point is, all of you are now starting to do that work. I'd like to see you show it off. Dr. Valentine, I would like to see you show it off in your appendix. It's not hard, right? You already did the work. Just make a quick little table or a chart and tuck it back there.
Yeah,
because you've earned it.
Yeah, that's fair.
Yep.
Yeah.
These appendices could be 10 pages long, so don't put everything there, but anything that you think that differentiates your work, by all means, put it in there.
Show off. It's okay. Yeah, you guys are doing good work. And since now we're going to show that off, let's do it. So,
absolutely.
All right. Thank you. All right. Who do we have next? Let's see.
I think we moved the next one.
I did too. I think we got Chris Deneweth, right? Where's
swap, Chris?
Jake? Yeah. Oh, Grace McCrea, maybe? Oh, okay. Come on up, Grace. Yeah. So we have Grace Schwartz, right? Pitching what are we here? Genmab. Genmab. And Grace has done some unique design for us. It's the beginnings of a template that we might be switching into, which will answer some key questions about what you're pitching and why and those things. And we're still including our boxes, but maybe an appendix showing you an alternative format. And then one of the original write-ups, I guess she produced, we don't have in front of us, is a timeline. I asked her to do that. Grace always does really good work in the pharma group. If you're a junior out there and you're not aligned with Grace, but you have interest in following the pharma group, I would highly recommend to see if you can buy her a beer or get an hour of her time, because she has the best models we produce so far in the AIM program in that sector. And I'd like you to kind of be able to copy and learn from that skill set. How's that for an intro?
Thank you, Dr. Wolf.
Take us away.
Hi, everyone. My name is Grace Schwartz. I'm a senior in the AIM program, and today, and I cover the international healthcare sector. And today I will be pitching a buy for Genmab, ticker GMAB, at a price of 3,399 Danish kroners, which represents a 28% upside. And this translates to a $44.19 ADR. So that's actually what we will be purchasing. But for the purposes of this, everything that I will be saying in my entire write-up is in Danish kroners. So kind of how I screened for this company, I've been kind of doing a lot of biotechs for a while, and most of the time when I would pitch a biotech, it would be very reliant on like 1 or 2 drugs. A lot of these drugs hadn't come out yet, but were like promising really big and great things. And that was really fun and a great learning experience. But I did want to try to kind of pitch a company that had new drugs, which I do talk about, but also have recurring revenues from some more established drugs, which in this case, the newer drug is Tivdak, and the older drug is Darzalex, which has been on the market since 2020. So that's kind of how I got into my screening. And then one comment that I got a decent amount was kind of about the risk of a currency exchange, because the company does operate in Danish kroners. So what I will say for that is that I definitely looked into that when I kind of first started looking at the company. And Denmark does conduct a fixed rate exchange policy against the euro. So the Danish kroner is held stable against the euro, which I do think this will kind of help stabilize prices. However, one kind of additional good thing is that because this company collaborates with a lot of bigger companies that operate in US dollars, that also kind of mitigates the currency exchange rate risk. And I'll open it up to questions.
Questions from the crowd? 1, 2.
Why does EPS fall in 2024 while operating income is rising?
Yeah, so in 2024?
Yep.
So a big reason for this kind of drop in EPS in 2024 is actually because for the past couple of years and into the first 2 years of my forecast, the company is paying 12.5% income tax. And this is partially from like COVID tax breaks and stuff like that. And that's guaranteed up till 2023. They're hoping to extend this, but for forecasting purposes, I had this rate increasing to 22%, which is the corporate tax rate in Denmark.
Thank you.
August.
Did you do any market sizing, or I don't know, like how did you get the calculation of 2% market penetration?
Yeah, so kind of when I do start with forecasting this, like when I start with forecasting these drugs, I initially start by looking at the market and then kind of break it down to what specifically this drug will treat. And so to kind of break down my thought process through that, so cervical cancer, there are about 660,000 people suffering with cervical cancer, and there's 170,000 people with metastatic cervical cancer, which is what Tivdak, this drug, treats. So basically, I kind of looked at what consensus is saying, and they're saying it's going to be 0.3% that first year, which would actually come out to saying that 500 people all throughout the world will be using this treatment, which I don't think is correct, especially since they have announced that new, they have announced a new commercialization partnership with a lab in Asia, which will kind of help disperse that, disperse the drug throughout those regions. So that's kind of how I got to, I have a 1% market share in the first year, and then that kind of expanding as the drug catches on. And this also, Tivdak is the only drug of its kind. It's the only current treatment on the market for metastatic cervical cancer. So that kind of also went into my decision.
So Grace, when you model a pharma, they're pretty easy and straightforward, right? You just kind of like put in a growth rate and call. So can you walk us through what August just asked, right? So August picked a particular drug for those that are new to this that might have felt a little heady there, but they have, how many drugs are in what are called the pipeline?
They have, I have a specific, they have like 20 drugs that are in their pipeline.
And what does pipeline mean? What does that mean for the rest of us that don't know it? My dad's watching right now. What is it? What is this, like a oil pipeline, or are we violating the IPS of Marquette? What does that mean?
Pretty similar. No, so the pipeline is kind of any drugs that the company's working on. So this can contain commercialized drugs, of which they have 5 on the market right now, or it can, like, it also takes into consideration all drugs in clinical trials, all drugs that are not fully formed drugs that might just be antibodies.
So do you just assume those all eventually get produced, or what do you do with that?
So for this particularly, I kind of like to break it out by, first you want to look at the timeline. So for a lot of these clinical trials, the timelines, like for phase 3 clinical trials, it can take 1 to 4 years for a drug to be produced. And obviously I'm only forecasting out 5 years. So you have to be very picky with kind of the ones that you're going to project revenues in your forecasts. So
Do any of them fail? Do you account for that, or they all get through?
well, for this specific one, you do account for if they fail. For this particular model, I did not, because I only looked at 2
So if you only pick
Or I
2
only
of
looked at
20,
one.
you basically assume the other 18 can fail and it only
Yeah.
produces more upside,
Yes.
which also can work.
In the past, we would have, like, I would have times this or added in a probability of success, which Dr. Valentine and I talked about, but you would adjust this probability of success for how far along the process they
Thanks.
are. So 60% of phase 3 drugs get
Yeah,
in.
but this is an alternative path, right? If you're projecting, if you run it, my point to all of you is, even if it's not a pharma, you come into a company, they've got 20 different products that don't seem that well correlated. They land in so many different buckets, and you go, gosh, how do I sort this out? Well, one is I put probability of success on each bucket, I do it all. Well, that works pretty good if you got 5 or 6. You get up to 20, you're going to start having your hands full. Well, another way is, what are the most promising ones? Which one are material? Okay, if I project those and I still get upside, I'm in pretty good shape, because in Grace's case, if any of the other 18 hit, that's just more upside. So, half dozen one, dozen the other, but my point is this applies to many of you, right? So companies that are multi-segmented, the more they get, the more this approach could be valuable to your own work. So I like to use sometimes these teaching moments. Thank you. Anybody else? Yeah.
Yeah, so you mentioned how many people have this disease. It seems like a really niche market. Can you talk about like the margins they're making on this drug, and like is the growth rate of this disease growing?
Yeah, so right now they have, it is a very niche market because what a lot of these drugs do, so like obviously cervical cancer is like pretty like well studied, and there are a lot of companies that are trying to produce treatments, but what this company has done is just pick a very like late stage. So when it's metastatic, that means that the cancer keeps coming back. So a lot of these patients have already done things like chemotherapy and have been kind of through the ringer with that. So where these drugs kind of can come in is they are really meant more to be like a treatment. So when I kind of model this out, a patient that uses this has been shown to have like a 5-year survival rate, and this is trying to extend that. So in clinical trials, the people that did continue to use this, it expanded their like 85% of them had a survive, or they all survived. So this is kind of expanding that survival rate. So people will keep using this drug, and it's also obviously very expensive. So that kind of also helps.
Yeah, we're just throwing him real quick, because this comes up a lot, especially when it's an really unknown product line that's coming out. So this idea of total addressable market is really important to be thinking about when you're doing your work. And because number one, the company will give you a total addressable market, usually like here. And then yet when you go do a little more work, you're like, no, it's probably here. When I covered FedEx, people were talking about when FedEx get into China. They're like, well, what if everybody in China starts using FedEx like they do in the US? Well, they could, but people aren't sending paying $20 to ship things around like they do in the United States. They're spending like $2, and just based on where the economy is there. So what it's helpful to do is to think about what the real total addressable market is, and not just take management's guidance. So that when you get these kinds of questions here, you can say it's $1 billion, it's 500 million, it's whatever, and then you can look at it relative to whatever, how much of a revenue you get ascribed to it. Does that make sense?
Yeah, so the way that I kind of went about doing that was I actually started with the most, I didn't use management's expectations for that, but I started with the most credible, which was a 2021 study done by the World Health Organization.
Great.
Of how many people have it, and then kind of broke down into how many males are, I think it's like I basically broke down how many men have it versus how many women have it, and then I kind of extended that to just the overall world growth rate, and that's how I got to my market, and then multiplied that by the average price of a treatment of this kind.
Okay, that's great. And so I love how you did that. The one thing you want to be thinking about is everybody in the world, take all 7 billion people, do they all have the same access to healthcare and prescription medicines? So, and by the way, I think your 1% is probably conservative. So I'm not saying you're wrong in there, but I'm saying those are the types of things that you want to do when you take total addressable market. That in itself could be a few hour analysis to try to make sure you really understand how big this market could be.
Yeah, definitely.
Which again, my one knock would be, consider including a couple charts showing us how you address the TAM. That would be a value add for the whole class if you're
you ever did that, or you want to have a follow-up, or consider showing them what a pipeline looks like. Those are things that make you get followed, right?
Yeah.
For those that are juniors in the class, you know, Dr. Valentine come back from different backgrounds. We both approach our own cluster. He's writing reports, I'm reading them. I can tell you the people I read were the ones that did that, the ones that would tell me why their report was more valuable than the other 10 reports covering the same thing. When I started trusting in someone, I go, oh, I got to know Grace. She's following TAMS. She's got a method I'm comfortable with. She showed that off. Oh, she actually underestimates pipeline and still produces winners for me. I start following her and I ignore the other 10. It's just kind of how things work. If you get your own following, you can create your own line of business. And so that's how you create value in the world you're about to go into. Yeah. Well, cool. I'll have one question at the very end for you, but otherwise we're good. Thanks, Grace. All right, Chris. Next up, we got Everi Holdings. Same thing. If you tell us how you came upon this company and what you want to clean up, and we'll keep things moving.
Hello, everybody. Chris Deneweth. I am a senior in the AIM program covering domestic information technology. So one of the companies, or I guess the company that I'll be pitching today is Everi Holdings. I've actually been following this company since about 2020. I really like their business model, like the products they produced, and being kind of a gambler myself, I thought it was very interesting, kind of following the market. As I was just in Las Vegas and saw a bunch of these Everi ATM machines, which also I saw a bunch of their slot machines. So I really it's kind of one of the first experiences I had of actually seeing this company out in the world and kind of, having a real world experience. So kind of being in the casino, I was able to talk to some of the pit bosses and dealers and ask about kind of how the market's been, how the casino foot traffic's been, and so get a little bit of personal insight from people who are actually working in the industry. And some of the pit bosses and everything said that this is kind of the busiest they've ever seen the casinos. They're at full staff. All the slot machines are in use. So that was one thing that really kind of drove my interest in this company for my pitch today. And then I also began to look at kind of what they've done to innovate kind of past just selling slot machines, because you can only sell so many slot machines and there's only going to be so many casinos out there in the world. So that's when I kind of stumbled upon their fintech division. They're an industry leader, offering a product that no other company is currently offering, and they are way ahead of it, which is kind of we've got to hear Mr. Maluli speak today. They're currently developing a moat in this industry, which obviously moat is very valuable. And then one thing that I would like to touch on today is, I guess sometimes people are looking out for you, and my third driver today was, for today was acquisitions and expansion. 3 days ago, Everi just acquired Deneweth. I'm mispronouncing it, but they are kind of a privately owned innovator of mobile-first technology, offering a first-in-class customer experience for sporting events, ticket sales. They offer in-app sports gambling. So they're kind of just a full sale, offer everything all in one area. Deneweth, again, mispronouncing it, but they are currently partnered with 9 professional leagues: PGA Tour, Churchill Downs, the TD Garden, Major League Baseball, Major League Soccer, National Basketball League, the NHL. So they are a very successful company founded in 2014. And so kind of the integration of Deneweth's platform into, or I guess Everi's platform into Deneweth's current existing app will be a very profitable one, because it's kind of the first time that they've been able to expand outside of just the casino and gaming industry. And now they are, Deneweth's app offers, you can buy tickets, you can, like I was saying, sports gamble. So it's just kind of a one-stop shop for everything sports and entertainment. And with that, I will open up the floor.
So, given Benut's, and we talked about it, I'm probably mispronouncing it as well. By the way, if you guys ever have a company that you don't know how to pronounce, or a person that you don't, you're gonna introduce it up Google, right? And just, or go on to YouTube and watch someone talk about it, right? Or I suspect the CEO somewhere has been on video. But anyway, the point is, you talked about Benut, sounds like it's maybe an exciting thing. Can you walk us through the materiality of that acquisition, specifically how much does it impact earnings per share in 2024 and 2025?
Yeah, absolutely. So one, it was acquired through cash on hand, so they did not have to bring out or do any additional debt, which is always a positive because with interest rates so high, it's a large interest expense. So in my model, I obviously, since this happened 3 days ago, I did not integrate it into my model or into my DCF for earnings per share. But I believe that it'll have since it's a privately owned company, they do not offer any sort of, current revenues or expenses or anything like that. So I tried to do as much research as I can. It's kind of the best guess was around 20 million in sales. And then obviously having such fantastic partnerships, they're going to continue that sales growth. And then integrating Everi's fintech division with their loyalty programs. Now they're operating or starting to get into some of that crypto and digital wallets. So really kind of trying to be on the leading edge of this technology. My best guess is it'll have somewhere around a 20-cent EPS.
Wow, so $20 million is going to result in 20 cents per share?
Especially, well, because it's a software service, so that it's not as much of a increase in cost of goods sold. So they can very inexpensively integrate Everi's loyalty program into Benut's current platform, and also they have kind of they're expanding their addressable market, which will just continue to drive revenues in both companies. And then also,
Sorry, just for a second, if you don't have the number, it's fine. Just say you don't have the number. But I'm not saying you don't have the number. But what I'm trying to get at is that you just said 20 million of revenue, but your company for this year is expecting 760 million of revenue. So is 20 million going to have a material impact? Of 20 million of revenue out of a company that's got 760 million of revenue could be a material impact on earnings per share.
I guess you are right. I could be highballing that. Again, I do not have the exact number.
Okay, that's fine. Just say it on the number. But the reason why I was asking is because it sounded like part of your pitch today was about this Benut's acquisition. I was trying to understand, is this one of your key elements?
It is not. Since it just came out, I wanted to, kind of tell everyone in the room about it.
Okay, good. And so my real question is, for 2024, your earnings per share are $22.23 a share, which is 37% higher than consensus. So what are these analysts missing? And what have you discovered that's going to cause their estimates to go up by 37%?
Yeah, absolutely. I knew this question was coming, as obviously it's kind of been a major trend. And I answered this on D2L. So kind of starting at 74% of their revenue is kind of that recurring revenue with minimal costs. And since the casino industry is such a regulated industry and they don't have very many articles published and kind of keep it private, it's kind of difficult to figure out what's the average number of slot machines and slot machines that are purchased and I guess not renewed, but kind of, I don't even know what the word is, but switched out, replaced. That's what I was looking for. How many slot machines are replaced? One analyst at B. Riley, which is kind of a smaller firm, kind of estimated about 20,000. And the first company he pointed out was Everi, just because their kind of ecosystem with the development of their fintech segment and their gaming hardware is kind of developing that ecosystem that Apple has, where their products go so well together, and also their anti-money laundering, which obviously is a huge fintech thing right now, especially also in the gambling industry. Kind of just they go so well together, so one drives the other. So if you kind of put those together, it's going to really increase revenue, and also just since it's again kind of those recurring revenues, it doesn't cost as much of that cost of goods sold and operational costs. And then also
So how many? There's 20,000 machines replaced. I'm a big fan of quantification.
Yes.
Right? And So I'll take any form of answer, but I normally would be looking to try, see if I could figure out, well, how much extra revenue does that generate for Everi? Or what is the street estimating that number of replacements to be? In other words, to get to Dr. Valentine's question, you answered the lead. The lead is, I think there's replacements, which is great. Does the street not see any replacements? How many more do you see? How do you know that how do you know they don't see alternatives?
That's my question. Is
Yeah.
What did you do
Yep.
that gives you confidence that the street is going to raise their numbers 37%, which is ginormous?
Like you started the answer great, and you may have it, and that's why I'm trying to help you guide you to. What is it? So you identified an area. It sounds like you think you know something about the replacements, right? Is that fair?
Yes.
What is it that you know that you can quantify, that you know the street didn't catch that you have? Like, what's the number?
It's kind of, I don't have a technical number. Or
And why do you think you're so much higher? Like,
just because of how, kind of the moat that they have and how,
that's
I'm
just,
feeling-
how do you know that the street didn't already put all 20,000 replacements into their number?
Yeah, so do you think
I'm
the
trying to
street-
help you, but I'm lost right now.
I mean, I obviously cannot, but
Did you
kind of-
read any of their reports? Did they say anything about replacements?
not really. They just kind of stated that the casino industry, after 2 down years during COVID, a lot of that CapEx. So I try to do a lot of CapEx research into the actual casino industry.
Did you depart from the street on your CapEx? Do you know a report that you depart from? I'm trying to help.
So again, it's kind of wishy-washy about exactly, but they've said that
If you're a
they're
super sharp
increasing.
guy, I would encourage you, and I'd encourage everyone, that if you're gonna make a statement, we depart by a good amount, and I think you all should. Think about what we just asked. It's not to put your pitch down, but to have just be a teaching moment, right? I'm gonna say, I know there's 20,000 machines that are gonna get replaced, and my company is likely to get most of that because we have the best tech. That's equivalent to what you said. We got a lot of ways we get to service the tech, so we're gonna double up. Brilliant. How do you know everybody else missed that, right? That's my differentiator. Jim's a pretty smart guy. How do I know he missed it and I caught it? If you could come up with any method to show me that, if you could say, hey, I got CapEx spend at 50% more in the street because I'm assuming that, or I looked at Jim's report and he said they're only going to service 5,000 of those, or I looked at a different report and I saw that the revenue, I did the backwards math, and I know they make about $2,000 per machine per month, and all the analysts are only assuming 500, so I know they're only assuming a quarter. Anything that will help quantify that difference then will give us, as a community, a lot more belief in it, just other than it's like, well, I know they do this thing. Well, that's good, we all agree, but we need to make sure that the other people didn't catch it and you did. Do you see that?
Yes.
Perfect. Is that fair? Sorry.
It's awesome. No, I fully agree. And we're not against you potentially looking at, let's say there's a bull out there in stock, and they're making that same argument that you're thinking makes
Well, you may
sense.
say one of the analysts.
We don't have a problem with
from
you
everybody
kind of
else,
riding
and
that
I
person's
like what they
coattails,
did.
but they need to be able to, you need to be able to have something substantial. You see, well, there is one analyst out here who's
It
in my
looks like a
thought
crazy
process.
person, but they're right.
Yeah, but I think they're right. I think this is why,
That also
and they
works.
hopefully did the high on the
I know you
street.
could do this for us, so it's-
Yeah.
Yep, and then my question, did you have more, Dr.?
No.
So my question would be, I love the fact you got a survey. Could you just very briefly tell me, like, who are the people that you surveyed? What am I supposed to take away? Because
How does this tie to your investment?
yeah, that's I was hoping that maybe somehow this related. I'm trying
Yes,
to
yeah.
lead you to the water.
Yeah,
in
same
case
here.
it
I
does.
love the
Yep.
fact you did some proprietary
Yep.
research. Excellent.
Yep.
Tied
So-
to your call.
So I sent my survey around to people of all ages, parents, kids 18, pretty much.
Is it the Marquette community? Is it just
No,
online, or
I asked people from Florida to Michigan.
inside your personal network?
Yes.
That's fine. No, this is good. I just want to know what we're looking at.
But yes, I wanted to make sure that I wasn't just asking, 18-year-olds at Marquette.
No problem.
because
That's okay. I just want to know what we're looking at right
Yes, so I tried to diversify my survey as much as possible, but, the first question obviously would participate in gambling. That's the company I'm pitching, so I want to kind of make sure they do that. And then withdraw, so obviously they do ATMs and receiving, they don't specifically tell me what they receive, but an average fee of $3 per ATM transaction. So with 80% of people withdrawing, I believe that's just a large increase to that revenue, recurring revenue, as they don't have to add more ATM machines. They just keep getting that fee.
So do any of these questions differ from other stuff you've read? Like, did you ever read a trade article that said, last year, it turns out only 65% of people withdrew money when going to a casino, or maybe less people gambled, or any. In other words, do you have any? It's back to the same kind of question I asked before. I love what you've done. Do you have a way I can now quantify that relative to someone else who did something or anything I know about the industry, so that I know you, hey, you know what I figured out, guys? You see this online gambling? It's 86%. That's a huge uptick. Last year it was only 70%. And if I'm right, I'm going to have a lot of people using companies just like mine. And even though I can't quantify it the way you and Dr. Valentine just asked, I can tell you 16% uptick in online gambling is roughly going to equate to something like 10,000 machines. That also would do it. Does that make sense?
Yes. And one thing I'll say about that was in my second driver, there was 10 million players that withdrew about 37+ billion in cash.
Look at this.
Which is up 22% from pre-pandemic levels. And I believe, I know the more people I talk to carry less and less cash. And most casinos, I guess all casinos are all cash. So that the less people hold cash on them, the more that they have to hit the ATM.
So is this yes number higher than other stuff you'd seen?
Yes.
How much higher? I'm gonna drag you there. I know you got this answer in you. I'm sorry. I'm determined to
I
get
would
it
say
out.
it's about 5% higher.
Great. We got 5% higher. How many cash casinos do we have, or dollars or anything? You told me some million.
So they had just out of every ATMs, they had 10 million people withdraw 37+ billion in cash.
Great. So if we took Dr. Valentine for a TAM, 37 billion, multiplied it by 5%, we now know there's an extra, what is that, 1.85 billion in play for this company and companies like it than we used to have. I took that, and you probably didn't do the next part, and I figured out about what my market share is, and that's how I got to this extra upside everyone else is missing. Is that an acceptable answer for us? No, it's all, you got the, you're like 1 millimeter from it. You guys see where we are?
Yeah.
I'm sorry to spend so long, but I love you so much, and you guys have these answers.
Yeah.
You're doing the work.
Yeah,
I just want you to close. That's why we're doing this. Cool?
Thank you, Dr. Wall.
Yep. No, awesome. Yep.
Can I ask, for me at least, one final question? With your margins, back on in your box here, your margins go from 30% to 40%. Can you walk me through specifically what they're going to do to be able to improve the margins?
Yeah, absolutely. So I believe that is in their iGaming, which is online casinos and slot machines. I believe that's in that segment, as it is very low cost to add another slot machine or gaming venture to their platform. And with the inclusion or the acquisition of Atlas Gaming, they are expanding into the second largest slot machine market in their world, right behind North America. So the more people that play that, and I believe that's the other reason why I included the U.S. sports betting mobile chart in the bottom, is there will be more and more states allowing sports betting, which will increase the online traffic of those slot machines, which doesn't increase cost, but will increase revenues.
How much greater are online margins than in-person margins? Ish.
They don't tell me.
Well, how much are Bailey? How much are Caesar's margins, or any comp you looked up? Do you know what their margins are by chance?
Okay. They just kind of all group them together.
Okay.
I'm not going to throw out a number.
No, you did great, but that would be another way in this industry, right? Just go find any physical casino, figure out what their current margins are, look for a pure online casino, look at their margins. Now I can give a really great answer to Dr. Valentine on why my margins are going to increase.
Right, you say it's 5% of business now, it's going to be 30% of the business, and just do the math, right? So the margins of this, they're going to go to this.
Yeah. You're doing great. Okay, thank you.
You can give me as much as you want. I'll do it.
You're doing great. Like I said,
Just had it.
you do have it. That's my point. You got everything in front of you.
Yes.
Right? Don't turn you into killer clothes. That's all. Yeah. All right. So next up, we got Jake. And Jake, same thing, if you can walk us through kind of how you came upon this company, anything that might be left, and then we'll start our review. And I forgot, do you have differentiators in here? You do, well, that's, so we might get into that a little bit.
Thank you, Dr. Wall. So my name is Jake Bernarde, and I'm a senior in the Applied Investment Management program. I cover the international consumer staples sector. And today I'll be pitching Alimentation Couche-Tard, ticker ANCTF, with a price target of $50, representing an upside of 19%. And in my screening process, I was looking for a company with strong EPS growth, also opportunities for midterm growth, and then also a company that's well positioned relative to the industry and the operating environment. And also the company's trading at a discount to its historical levels and to its peers. And the last thing I had to add for the screening process was we don't currently own a retailer in the international consumer staples segment. We own a lot of like providers of goods, but not really any like hard brick and mortar stores. So this is kind of want to shift that way a little bit as well. And then one question that came up a lot on DTOL was my revenue estimates decreasing in 24 and then increasing slightly after. So their revenues are not correlated, but dependent upon gasoline a lot. So with a estimating compression of the price of gasoline in 24, the top line would see a significant, if not a little bit, a slight decrease in revenues in the top line. And so my revenue forecasts in this year are slightly above the consensus estimates, but due to the uncertainty, this is kind of why I have it just decreasing a little bit there. And another thing about this segment is it's high volume, kind of low margin. So especially compared to the merchandise and service segment. So if you looked at my segment analysis, you can see that the transportation fuel segment represents about 72% of overall revenues, but only generates less than half of the gross profit, compared to that merchandise and service segment, which is about 26% of overall revenues, but is compiles to 54%-ish of the total gross profit. So because of this, I wouldn't say the revenue is a really good metric to value this company, or not to value, but to see the company's success and growth. And with that, I'll open up to some questions.
Grace jumped ahead of you. She slipped her hand up before you did, Dr. Valentine.
Watch out. So I'm just curious about I like that you used like the P multiple valuation, because we've been learning about that a lot in class.
Yeah.
So can you just talk a little bit about how you reached the weighted average P? Like, is that a market multiple, peer multiple?
Do you mean on my like in my boxes there, or do you mean like the
I'm looking at your valuation, 17.5 times.
Yeah, so for that I used more like kind of the older approach where you just put the weighted average of, so one of my peers is 6% and then the other two are 20% each. But kind of going off of that, I looked at their EPS growth rates going back, which is kind of like the alternative part of the research I did, and wanted to make sure they were in line with the same, like similar growth rates going forward. So these are my estimates in the top row if you look all at the bottom of my write-up, but so at 14% CAGR, it's actually, they're trading at discount to these peers, but also growing faster from my estimates. And the street's at about 12% here, so I'm slightly above that from their estimates from, well, I got the 2 estimate years there, but then the historicals obviously are where they're at. So does that help?
Yeah, and then kind of why did you weigh George Weston Limited so much higher?
Yeah, so first I'll start with the other 2 peers. They so it's 7-Eleven and Casey's, which Circle K is obviously very, we got Casey's over here, and Circle K is pretty similar. It's kind of the same business model, convenience store, gas station, that kind of thing. So, but they are higher value to them, so I didn't really want to weight them higher than, because they would just like inflate the price, obviously, the price started. But George Weston Limited is a Canadian company, and they're engaged in like the processing and distribution of some of these products that they sell in stores. And then their business model is different, I guess, but both these companies have like the closest EPS growth rates, and their stocks in a discussion post. I don't know if you saw that, but their stock has been kind of not correlated, but they've been closely kind of trading at similar levels. And then they're also a Canadian firm, like I said, so they face similar challenges kind of in operating environment. So I felt like they were the most closely related peer to them.
Yeah, makes sense. Thank you.
So first I want to applaud you for the 2 elements you have on here. One, the upside downside base case scenarios, which at some point we'll be going over that, but in class. But then the other is down below there. You show your EPS growth rates of the peers, and you're thinking about that, and you're thinking about valuation multiples, which is excellent. Where I'm a little bit confused is you've got back on your first box, page 1 box,
Yep.
Second column where it says interim EPS growth rate S, it's 2.2. What does that mean?
And which box?
Your midterm.
So you're on your very first page of the
Oh,
box?
yeah, the EPS growth rate.
Yeah, so what,
So
what
that's,
is that?
I know that's, I mean, it's not like a great metric or anything, but it's like the 3rd to 5th year growth rate. So it's like midterm growth rate.
Okay, so it's a super important metric, right?
Yeah, yeah, no.
So you've got a company that's growing at 2.2% per year, and you think it's going to trade at a 17.5 multiple, which is higher than the market multiple of 15 and a half. So can you reconcile when the S&P typically grows between 5 and 7, earning 5 to 7% a year? You've got a company growing half as fast, and yet you're putting a higher multiple on it.
Yeah, so, so I do have the company accelerating their growth faster than the street in 2024, which is kind of why, so I have the EPS growth in closer to 17 or 10% in the next 2 years, and then kind of slowing down a little bit just because
Sorry, what rates do you have for the next 2 years?
So from this year, the fiscal year is April, so we're about halfway through it. It's going to 17%, so 2.97, and then to 10%.
Guys, I think there's an error here, if I can just pitch in for a
Yeah.
second. Can you give me your 2026 earnings per share-ish?
3.6.
Okay, so that is slow. I see the growth rate in revenue for years 3. Are you talking years 3 being 24, 25, 26? 3 to 5? on your
25
midterm?
through 27.
Okay, then let me back up. What do you got 27 EPS?
3.8.
Yeah, so I'm going from 3.6 to 3.8 in a 2-year window, Jim. I think he's modeling revenue growth rather than EPS growth in that box. Did you double check your work?
Yeah, I can double check that number.
If I
It
do
does seem
revenue
low.
growth where I start with -2, then I go 1.1, then I go 2, I'm getting a lot closer to his 2.2. And if I go the EPS growth, I see at the bottom. Do you see that?
What is the EPS growth?
So if I just go from here
Yeah.
to 3.8,
Yeah.
and then, or I go from here where it's down, up 2, it's gonna look a lot closer like that. I think he's got this going in here.
Okay.
Yeah, I can circle back for that for sure, because that does seem low.
So, yeah, I guess where I'm coming from is that it doesn't look like, even if I look at these numbers here and I go, you're going from 357 from 330, it doesn't look like a lot of growth. And for 17.5 multiple is a growthier company. It's well above the S&P 500. So my basic question is, why would a company that's not growing faster than the S&P 500 get a PE multiple that's higher than the S&P 500?
Yeah, so I mean, I don't know if it could be part of the shift to consumer staples. People are willing to pay higher multiples for these companies. But if you look at that peer chart, the same chart kind of what we're looking at, like you see Casey's is only growing probably less over that same period than Couche-Tard. So they're trading at a higher multiple, but they're kind of growing slower even.
Okay, I like this. So basically you're saying you think because people are concerned about a recession, they're saying, look, you're still going to go to 7-Elevens and
Yeah.
Casey's General Stores. So this is a place for equity and for the money managers to hide out and stay safe. That's good. But then when things wind down, presumably we get out of a recession, right? Recessionary mindset. Is that to say then these multiples will probably compress and you see the stock underperform?
Potentially, but I think the drivers that I have, that some of the things that the street is missing could differentiate the stock going forward. Which, for example, in my fresh food segment, my first driver, I talk about the fresh food segment and shift to that more profitable segment and like the private label growth there. So I think this is something that they're missing because along with the shift to EV, which is my last driver, the conversion rates go from 17% to 40%, which is more than double.
So what is the conversion rate?
17. Oh, it's the amount of people for every person that comes to the store, the amount that go in and actually buy something. So at traditional sites, about 17% of people do this, and at any EV site, 40% of people, which is significantly higher. And I think this is something that they're missing that street is missing going forward because that's more than double the people, so that's going to contribute a lot to revenue just due to the time that someone has to wait to charge a car, obviously. And I also think this is going to hit the bottom line faster, which is why I have my 2024 estimate higher than their 2024 estimate, and then kind of converging more to consensus as the years go on, if that makes sense.
Yeah.
So for the EV charging station, stores.
Yeah.
How does gross profit or contribution profit change per visit? They have higher conversion, but with them not buying gas, is it less?
Yeah, so I wasn't really pitching the kind of the transaction of the sale of electric itself.
Mm.
It was actually really hard to find any information on that, just because they're really big in Norway right now, as I said in my pitch, but it's actually project how it's going to expand to other regions in like the U.S., but they didn't really provide much color on how it affected their operations inside the stores, so like the merchandise and service, but not the
The question
sale
might
itself.
be, does it, maybe not, but does it hurt them because I think you know the answer, but because they've not selling gasoline to these people?
Well, I don't think these would be people who would come in the gas station if not, unless they were going to just get a snack.
No, but
That
I
makes
guess what I'm
sense.
saying is if you have, let's say, more and more cars coming by, pulling in,
Yeah.
that are not buying gas, that's good because they're gonna come in while they're waiting to charge, they're gonna spend money, but they're also not buying the gas from you, right? So I guess, is there a concern? I think you told me privately that they don't make much profit on the gas, right?
Yeah,
So
so
I
I
think that's
mean-
a concern.
Yeah, so I mean, like I guess you kind of just said it, that they're not really making as much money from this gas, so they'd rather have it's a more valuable customer to have the EV person come in and go in the store and buy something versus someone that could pull up and buy gas, I'd say.
And then to follow up on that, on visits, is there a decline in visits for EV customers versus gasoline? Like, since they can charge at home anyways, why would they even come to the store?
Yeah, so I mean, it's kind of there wouldn't be a decline in visits just because it's a new market, so it's kind of a special point for them because they're growing both their gas and the EV because they're kind of differentiating from their competitors by offering both of them at the same time. So I mean, in the future, they could converge and say gas sales or transportation fuel sales would start to fall off and EV sales maybe start to take over more of a bigger segment of the revenue. But at the moment, in the next 5 years, I don't think it's growing fast enough, at least in their markets, to have a significant impact on the transportation fuel segment.
Thank you.
Okay.
Can you walk me through what you did on the appendix? It looks like you
Yeah.
You got a 3-step approach here, and it looks like your worst case is about the same as what you modeled. Is that true? Can you tell me why you did that, if that's true? Because you barely have any drop on your worst case from where you are now.
No, the worst case is indicating 3% from the current price.
Okay, got it.
So 3% downside from you bought it today.
Okay, and why are the other ones even realistic, and why aren't I weighting more towards them, right? So if I've got 3% drop on today's price in my worst case, and a 19 and a 37 on my upside, help me walk through the logic of those things.
So just so we're all clear,
Yeah.
the 19% is base case, right? And 37% is your upside, right?
Yeah.
In terms of stock price.
So, yeah, I
Sure.
love what you did. I prefer you label those things for the crowd.
Yeah,
So,
label column,
yeah.
column head.
Yeah.
Oh, yeah, sorry.
That's kind of what I'm trying to get at,
Okay.
into my own snarky little.
Yeah. I didn't even realize it wasn't on there. That's
No
my
worries.
bad.
Yep.
That makes sense.
So can you help us understand this? Because this is kind of interesting. I know, again, a lot of you are doing something like this behind the scenes, so I appreciate you showed off
Yeah.
what you guys are all doing.
So I guess I'll kind of start from the top there. So that's like my fresh food fats initiative. And if it performs better than I expect, based on my growth of that merchandise and service segment, I expect it to add an additional 15 points or 15 cents to EPS. Well, if it underperforms and it's maybe not implemented as fast as I think, then it's going to decrease the EPS by 10 cents. And this is kind of the same story going down, where you can see the impact of fuel inflation. Well, historically they've actually had better marginal, they've improved better. They've had better margins when gas prices are higher. This is still a risk just based on I guess more macro factors. That kind of goes along with the last one as well. So then this kind of funnels down to give me a better view of the company from the top level and kind of EPS in the future. So does that help?
Yep, it does. And then my last question is going to be similar to Max. I just want to double check the WACC here.
Yeah.
What's the market cap of the stock, roughly speaking?
About 44 billion,
Okay, and about how much debt do they have?
9 billion.
I worry a lot that debt to equity is flipped again. If they got 9 billion in debt, and they got 44 billion in equity, we got 9 out of
Yeah,
53 on the one side, and we got 44 out of 53 on the other side. You know what your cost of equity was?
8.9%,
And what was your cost of debt?
44.4%.
And
Yeah.
did you throw a risk premium on?
I did not.
All right.
It
so-
looks like, which I know this isn't the right way to do it, it looks like I pulled from the equity like from like the balance sheet rather than market value, which
So that's something I've been seeing in my own class, right? And I got to work that through in 4080. I'll do that. It's our own thing. I'm teaching accountants, and so we like book value. But we're an AIM. We want to make sure we focus ourselves on the market value of equity and ideally the market value of debt. Now, to be honest, a lot of your debt is going to be pretty close to what book is, and it's going to be a much more nuanced approach than something we'll teach you in the office. But the market value of equity is pretty easy to calculate, and it's throwing off our WACC spike quite a bit. So if you could rerun it,
I'll rerun it.
the correct WACC is and tell us the upside downside that generates that. Appreciate it.
Yeah,
Sounds
in
good.
terms of the weights.
Yep.
Yep, I will. Thank you. Any other questions?
All right. Thank you.
I'll take
All right, Grace, come on up and walk us through how you picked Decker's Outdoor. Anything you want us to know, and go forward from there. Thank you.
Hi everyone, my name is Grace McCrea. I cover domestic consumer discretionary, and I'll be pitching a hold on Decker's Outdoor Corporation. Basically, a little bit about my screening process was I looked at FinViz, and I started off with just my sector and US-based companies, and then I like to focus on companies with lower levels of debt, especially with higher interest rates, and in like a volatile market, which you'll note that my company has only 11% debt to equity, and also some like really good profitability margins, especially in relation to their peers. And then a question that I got kind of a lot on D2L is just about the growth of the company, and this is how I kind of come into my recommendation as a whole, and also where I differ from consensus. So basically, the direct-to-consumer and UGG segments of the company have been holding steady at like 35 to 38%, both of them have.
As a percentage of revenue?
Yes, as a percent of revenue, so that adds to like 70% of total revenue, and those have been steady for like about 5 years each, so I'm expecting those to stay pretty steady, and then some of their smaller segments just represent about like 1 to like 4% of revenue, so also expecting those to stay steady. Where I kind of differ is that in the Hoka segment, so Decker's just started selling Hoka in 2019, where it started at 9% of their revenue and quickly went to 13 and 16 and now 20% of revenue. So I think a lot of their growth that they've seen from Hoka has been in the past, and I kind of see that revenue percent of revenue kind of leveling out at like 22%, where margin or where consensus differs, and they really expect a lot of growth there in the future. And I just, at this point, especially from management, I don't see how that would happen or where that growth would come from. So, any questions I can answer?
Great. Oh, sorry.
Yep.
You're doing great. You gotta go through.
Could you talk a little bit about how you came to the decision to kind of put it as a hold, and like what would it take for the company, like how much upside would you like to see since there is still some, and like when, like timeline wise, do you think we'll look back at this?
Oh yeah, definitely. Well, I think it would take probably some sort of an announcement for one of these segments to announce that they're, I don't know, introducing a new product or something like that, or another acquisition of Decker's as a whole, to see more upside. My DCF is obviously what I put like most of the work into, and that only gave me 4% upside. So after, like, if I had to redo the revenue segments after some sort of announcement like that, I would be much more confident in it.
Gotcha.
So kind of honestly just whenever that could happen, which at this point there isn't really any specifics.
Okay, thank you.
Dr. Valentine.
So it sounds like you might think that there's some hype in the stock because you're concerned. Is that a fair characterization?
Yeah, basically I just believe that consensus is too optimistic. If that's it.
Did you come across any research that you did on your own or things that you read that can give us greater conviction that the analysts are wrong or there's too much hype in the stock?
Well, I would say that the Hoka overall, like as a trend and just like in the fashion industry, I would say that the story has played out / is playing out right now. And they're in fiscal year 23 right now. So by the end of this, it would be fully played out. I don't have anything specifically that I've read, but it's more of what I like lack of reading, that there's just no reason to see, there's no reason to see this specific growth. That I'm seeing.
So are you pitching us a buy?
A hold.
Okay, got it. Yep, because I just saw the upside. Could you help me? I appreciate you including the alternative data piece. Could you help me understand how you can quantify that to help confirm something we're seeing or depart from something we're seeing?
Yeah, definitely. Well, for the trend, which is seen as the very cyclical line that is very seasonal, that's kind of obvious. And
so the one that's going up and down.
Up and down.
Sorry,
that's
black and white.
Yeah,
Sorry. Yep.
That's UGG, and honestly, that one was pretty obvious to me when I saw that, and probably a lot of you, because they focus on selling boots and slippers for the seasonal. The one that is, I guess, most interesting would be the Hoka, that their sales, or not sales, but the research and just the search trend has doubled over the past year. But again, that's kind of where I believe that the story has played out. And if interest has already doubled,
so if I
what's gonna
recreate
make
this
it
graph,
double
you
again?
think it's actually going to stop doing what it's doing?
Yes.
It looks like it's running probably about a 20% slope, and you think that's going to level out?
Yeah, just
If we
level
go
there.
forward
Not
a year.
necessarily
Yeah, I
the line,
understand.
but yeah.
Okay.
Which line, sorry, it's the first I've seen that. I didn't notice this. So you might want to just label these things. This goes for everybody. You might want to just label these really clear.
Yeah, but yeah, when they're assume
It's
they're
in
going to
black
be
and
printing in
white.
black and white,
Yeah.
consider trying to figure out a way to bold the one that's yours, if nothing else. That will help a little bit.
Yeah, that's really
Dr. Valentine, she's talking about the line that's straight that's on top.
Okay, so
So this one right here, she thinks we're going to level out now. And you see how we've been growing
Yeah,
18?
yeah.
And that she thinks we're actually going to level, and the street is actually continuing that growth trend.
got it. And I think this line actually, to me, does look like it's starting to roll over, doesn't it?
Yeah.
So you can even use that as a indicator. I really like this.
Yeah, the
Excellent.
most recent, there's a tip, the most recent.
Yeah. really good.
And so you've got some upside pitch, but I want to be real clear to the room, right? This is an interesting case. In some ways, we could almost say we're putting this on our watch list. We don't want to get in now because all those street analysts, when they're forced to downgrade because they're wrong, the stock will drop. We all agree. Why buy something we expect to drop? But if it drops enough, the data already says it's not such a terrible buy, and so it might be something that we want to put on a watch list if we had such a thing. Is that a fair way to look
Exactly.
at it?
That's why I was saying, if
Yeah.
you think a stock has too much hype in it, if it's still got good fundamentals, if there's something happens to take the hype out of it, that's when you get in.
Joe?
Yeah, I will say I love my Hoka shoes, so I'm gonna have to do kind of a little opposite on this side.
Are you quickly searching on Google to increase the search ranking?
No, I'm actually, no. So have you looked at any of the market share gain that they have gained over Brooks or over Nike? How Hoka's kind of, because from my experience, Hoka is not really well known in the running and starting to gain a lot of momentum along with a lot of other runners that I go with.
Yeah, definitely. That's something that Deckers has worked with Hoka with. I mentioned a campaign that just launched, and they just sponsored a run in Chicago, literally last weekend, I think. So I agree that it's not as I guess well known in the running space. I don't have a number for market share, but I know that Deckers distributes to a lot of different companies. So they I don't Nike wouldn't sell Hoka, but I don't know, Dick's Sporting Goods or a different brand. They just don't disclose who they distribute to, so that's hard for me to know.
Sorry, can you just step in for a second? So I want to make sure I understand your question. And so this work you did, I thought what this work is showing is based on social media trends or something. That Hoka's
Google
search.
searches.
Google search, good.
Yep. Search
Trends are
activity in
slowing.
general. Yep.
You've got someone in the audience that's saying, well, I personally think this thing's going to grow. You just come back and you kind of drop the mic and say, well, did you see my data here? I mean, and what is there somewhere am I not, am I missing this not really conclusive, or you don't think? I'm just
I
trying to
don't
use
even
a
know
code.
the answer
If
to
I were an
that.
analyst up there and I had something like this and someone asked me a question like that, I'd say, you know, to go back to exhibit 4, because as I mentioned earlier, we can see the trends are slowing. Not that it wasn't a decent question, but you see what I'm saying? Is that I think you've got, or no? Is this
Yeah,
not really
no,
good
yeah,
data?
that's, yeah.
Who owns Hoka?
I own it.
Hang on. Good. How many have you bought in the last year?
Me?
Yeah.
I bought one and buy another one in a couple months.
Okay, so our sample size is 1. Our growth rate, how many did you buy last year? 1?
Yeah.
You're gonna buy another one this year. So you're gonna flatline your growth.
But
I'm teasing you, Joe.
No,
Good job.
I was going off with my running group. Then was the numbers have grown substantially.
Totally understand. I'm playing around.
It was
There-
a good
there-
question.
Yep.
Question.
It was a great
But
question, and there
you
might
had
be
to
some
lay out
data
the
that counters what she found, and it's worthy of debate. I don't ever want to stop debate. Joe and I go way back. You will find if I go back with you, I will push a little more, because I know where he's coming from. And so he might have alternative data, and you can come back and say, well, I have runner's world that suggests otherwise. Well, great, we can have that talk offline. All good. Thank you. Yep. All right, Jack, come on up and tell us why we should support the nuclear effort. It's very topical, unfortunately.
Yeah, so I'm Jack. I'm a senior in the program. And a little bit, I'm pitching Uranium Energy Corp as a cell. A little bit of how I got into this company and what my screening process was like. I did a lot of research over the summer on the energy industry specifically, and had read a lot of research on like why nuclear power was like the future of energy production. And I really do believe in like the macro scale of this company. But getting into why it really didn't work was, well, this is the only U.S. uranium miner in the United States, so I didn't really have many options to choose from when looking at this. And the production is just too far out, and the cost to produce is too high for this company to make sense. It would need a price of uranium that's simply unreasonable, as the lower cost producers would undercut them and drop the price of uranium before they could, produce enough to make the kind of profit that the street is currently forecasting. The question I got at D12, actually a good amount, was about the correlation between the stock and the price of uranium. And I did a 3-year monthly landing average of the prices, and I came up with an 86% correlation. And with future prices pointing higher, right, a lot of people would think that actually means upside for the stock. But in talking with Dr. Valentine, I figured out, you're just going to have a lot of quant traders that can see that, and right, they're just going to instantly buy the stock when they see futures go up or down. So that's kind of already factored into the price. And this stock is actually outperformed the S&P by 40% so far this year, being up 18% on the year, while the S&P is down like 25%. So that's kind of factored into this as well. So I guess that I can open up to questions.
Dr. Valentine.
Yeah, so, well, I just want to clarify that. So I think it's a good point that Jack is making, is that if you find a trend with a strong correlation, it's kind of hard to say to the world, I found a trend by going to Excel and I got 2 columns that show a strong correlation, therefore I'm going to buy it, right? Presumably there's got to be something more than that. So I guess walk us through the process. This isn't really a stock pitch question, much more than kind of the process. Walk us through the process from when you initially, where I will just say you were kind of excited about it, to ultimately concluding that, you know what, this is probably going to be a hold.
Yeah, so I was really excited with this because I was reading a lot on the Russia-Ukraine stuff and looking at the potential for a banning of Russian imports of uranium. Which, if you don't know, Russia, Uzbekistan, and Kazakhstan make up like 50% of United States imports of uranium, which is obviously very important for our electricity production in the United States. So I thought that the price of uranium could have significant upside in that case, if that were to happen. There's a bill in the U.S. Senate on it. Along with that, I am a large believer in nuclear reactors, and I kind of outlined some of like the reasons I like it over solar, with like a lot less like carbon footprint and more sustainable 24/7 production. But so I was very excited in it, and then I was looking more at the micro and more at the micro, I realized a lot that they don't have the kind of scale. I talked about their scale in my third my driver, but the scale that they would need to be able to quantify, right, like the 1.3 billion valuation just isn't there. Right? They have like 75 million pounds of reserves I have there.
Tons, right? Tons.
Yeah, I have it in pounds. There's it in pounds, yeah.
75 million, right?
Yeah, 75 million. Well, there was like some new discoveries this week actually, which make it a little bit higher. I ran that as well, but you get at that, you get an EBIT, a margin of $17 per pound, and you run all the numbers, and you get through to after tax. You're looking at like 1.3 billion of EBIT of after tax profit on 75 million pounds if they're producing today. Well, this company is currently not producing anything, and these projects are years and years out, right? You start forecasting it at a 12% whack, and you really start to realize that this company is really being overhyped by the market based on the macro drivers of this company. So that kind of, I was frustrated at a point because I really do love the macro of this market, and it took me a little while to kind of realize that this is actually just a sub. So. Yeah.
That's great. And then if I can use that as a bit of a kind of a teachable moment, this is what can make stock picking just make it go crazy, because you got to separate the story from valuation. And you may love the story, you may love the shoe company that makes the Hoka shoes, but you've got to pause and say, well, hold on, wait, does it really make sense from a valuation perspective? Which is, I think, ultimately we came to the conclusion I did.
Yeah.
So well done.
So what's a pound of uranium cost?
Currently $50 per pound.
So could we pound the miner? Could we charge the miner back there, run off of one of those rocks, and we blow the room?
Not sure that's how it works.
I don't think so either. I'm teasing around. There could be a lot of bad reasons for that approach. But could you tell me about anything unique you did to get to where you got to, right? Could you walk us through the street? I looked, they're very bullish. They're saying, gosh, this guy's wrong. The uranium's going to soar, and this is the only pure play in all of North America on it. And I just looked up a couple of them, and they basically are contending you're way off your rocker. The uranium prices are going to triple in 3 years, and this isn't the only pure play. It's actually undervalued.
Yeah. So
what do you have to say back to that?
Yeah. So I would say is they aren't the only one in North America. They're the only one in the United States. There's a lot actually in Canada that's going on. If you look at Cameco Corp, as well as that, if you look at a lot of street analysts and estimates, they're using a 7.5% discount rate for this company, and I think that's far too low.
Why is that? Why is that off?
Well,
can you quantify it for me? How did you come up with yours?
Yeah, so this company has zero debt, so it makes it pretty easy. Using a 3.5% risk-free rate and a 5.5% market premium and a 1.5 beta came to
yeah, that matter doesn't add up to
12%, right? So yeah, that's a far too low discount rate I found from the street. I was actually pretty bullish on some of their production estimates. If you look at my numbers, I have their revenues actually.
What about uranium tripling in the next 3 years? I saw one of the reports said that. Is that pretty realistic?
Yeah, I'd say that's unrealistic due to a couple factors. You have to factor like Russia, Uzbekistan, and Kazakhstan just totally having zero production, being able to import into the United States for
they could use it all up bombing each other.
Yeah, so that's what would have to be happening, right? We would be talking about catastrophic world consequences.
And how do prices tend to do if the world goes to complete war and destroys each other?
It tend to go pretty well.
Does it triple? I don't know. No, I'm laughing a little bit, right? But there's one scenario where things triple. Yeah. Russia and Ukraine bomb the heck out of each other, drive up. On the one hand, we don't know what will happen. On the other hand, I would be willing to bet in the U.S. they'd cap uranium price. There's no way they'd let them go up 10,000 times. Right. And so you'd run into a whole new problem they're not even thinking about. Yeah. Point is, I was having some fun with it because, sorry, it's that time of day. But there's a lot of value in what he did, right? He said, hey, the WAC is way out of line. I can prove that mathematically. Dr. Wall thinks the revenue estimates, and I do too, and there's some reasons why I think that's way out of line. That doesn't make any sense. And no, by the way, they're not the only North American providers. There's this other country in North America called Canada that has a whole bunch of them. You might want to remember it exists, guys. And so when you put all that together, you go, maybe this isn't quite as bullish as we thought, which I appreciate the time you took into doing that. And again, I would encourage you, though, to kind of call that out. because that's some of the value add. Even if you don't get a buy-in here, and there's not an even if, Dr. Valentine are fine with that. Show the world what you just did. Show the world why they're wrong. You can do that. Every person in this program is capable of outperforming the world. The speech you're hearing is not one of us being mad. It's you guys, as you're starting to see, we're getting close to the point where you are a elite level analyst caliber beyond anything anyone else does that has 20 years experience. You're that far away. That's all we're trying to tease out of you today. Cool. Thanks. Oh, one more.
Is this company mining the uranium from rock, or is it coming from the ocean?
So yeah, this is from sandstone. That's primarily where uranium is found. So it's a lot of their productions in Texas, Arizona, Wyoming, and then they have they're part of one Canadian manufacturing site as well.
You said their cost to produce is pretty high. What is their like cost per kilogram? Or
per pound. So so the price of uranium right now is around $50. They're making about $17 a beat on that, so it's like right at that $33 to mine for pound of uranium.
All right, thank you. Last but not least, we have Max. Max, would you just go?
We should just go.
Yeah. Isn't that the stock summary?
Oh, yeah.
No. We're in great shape. I really look forward to dissecting this work, hearing you dissect it. And I love the fact that I got something here where it looks like you had, what, 2 people respond to a survey?
No, that's just...
I'm teasing. I want to hear about what you did. So take it away, please.
Perfect. So, I'm pitching Grocery Outlet Holding Corp, ticker GO, with the price target of $39.25, which is roughly 19% upside. My main thought process for this stock was basically being the consumer staple industry. I figured I could find a stock that could kind of hedge our bets, kind of make us not lose money, as we've seen the market kind of been down in recent. So came across this company and really liked the trends they've been showing over kind of our last 2 recessions, one being the 2008-2009 market crash. And then with COVID, they just kind of had a kind of nick for increasing their same-store sales during these recessionary periods. So as I've kind of, and then that kind of went along with my investment thesis of kind of we have this recession looming kind of with unemployment rising, GDP growth rate decreasing, and then just kind of the rising rates. So that's kind of how that was the main driver behind this stock. So I'll open up to questions.
Go ahead.
So you have a peer of Sprouts Farmers Market, and they appear to be better in just about every metric you've listed. Why are you not pitching that instead?
Yeah, that's a good question, but it really just comes down to the state of the market right now, and just kind of where earnings are going to be at in the next 2 years. According to my estimates, their earnings growth rate's just higher for Grocery Outlet. Yeah. So, and just kind of the.
But sorry, can we just stop? So, if we have 2 companies, do we always recommend the one that's a higher growth rate? Okay, so you can say what you said, but put it in the context of your company has a higher growth rate, and can you talk a little about valuation?
Yeah, I guess, well, the growth rate was kind of, I guess, my main driver, but then when you look at that peer table too, and with kind of I like my price to earnings to decrease in the near future, and then you also have just kind of the expansion of and kind of how my company is able to take advantage of the recessionary environments. And then you kind of have that Sprouts market being a more farmer's market aspect, higher end products, whereas the Grocery Outlet's a more discount, kind of 40% savings, whereas I think that's kind of better suited for consumers in a market like this.
Makes sense.
So along those lines, please follow. So why do you think that Grocery Outlet trades at 27 times, but Sprouts only trades at 12?
I feel like, well, that's just kind of indicative of past earnings and past success.
Past or maybe future growth, maybe?
I guess the future growth, but I guess kind of going off what you said too is our growth rate for earnings is higher than Sprouts in the next 2 years.
That's what I was trying to drive home.
Yeah, yeah.
It's okay to be recommending a stock that's got a high PE ratio if it's got a much higher growth rate.
Yeah, I guess that's what my main point there was, just with take up to 22, 23, and 24. our growth rate is significantly higher than that Sprouts.
So did you run a PEG ratio just to see if where it came in on future growth 2 years out or anything?
I did not. I didn't run a PEG ratio, but I did look at Sprouts's just estimates on FactSet. And that.
Because well, I agree with Dr. Valentine. I don't mind at all. I like to just kind of test the thesis, look out 2-3 years, apply what I think is a reasonable growth rate, and then it should kind of reveal itself if it's in line and it's got the PE band, even if you're not outperforming it. Then I'm a much stronger believer.
I can run that.
Yeah, cool. I think it's going to work in your favor, but I don't know. I'd love to see it.
And that, by the way, came up quite a bit this past week. Students are coming to me and asking about corporate earnings growth, and I said, well, you can just go, and so I thought someone did this actually. Yeah, so I think it was Jake on the page where he's got the upside downside base case. It's page, it says 18, but I guess it's page 18. Well, nice thing, he's got 2019, 2020, 2021, 2023, 24, and you can decide what you want to do the entire 6-year CAGR. You could say, let's just take 2021 because it's the last full year, go back to 2019 because it's the last pre-COVID year. And you could go all the way up to 2024, even 2025, if the estimates actually are more than just one estimate that makes up consensus. Because then it gives us a feel for growth. It's not just one number, because depending on a company might have a bad year. Company has a bad year, it's got a really low estimate. What does that mean its growth is going to look like next year? Really good, right? So you got to be careful about just using any one time period, especially if it's short, just 2 particular years.
So did you do anything to try to compensate for I love low beta plays myself, and I'm not saying you had to, but did you use any alternative approaches in terms of saying, did you do any searching for what you can do to estimate companies that have low betas, just to see if they're use a different method or an alternative method of WAC, just to test what that might do?
Yeah, so I tried to look into it, and honestly, I didn't really get any good material on kind of how to do it. And
there aren't super awesome methods. There's 2 more commonly accepted ones. I'd encourage you guys to come by Dr. Valentine and I's offices. It probably takes a little while to work through some of that stuff, right? So companies sometimes have negative betas, and then the CFA can suggest some ways to try to come up with alternative methods to approximate what their actual cost structure looks like. We can use existing debt. We can use market multiples like Dr. Valentine uses in PE bands, and then we can actually come up with WAC bands. At 0.38, we're getting dangerously close to the point where we probably should at least test that approach. And so all I'm suggesting is if you guys come in with a beta down in that really low range, I actually love those stocks because you're finding something that should balance out our portfolio. As we start thinking as portfolio managers, after we turn into elite analysts, we'll start thinking that way a little bit. Stuff like this is hugely value added, but we also want to do a little bit of a robustness check just to make sure that if they have normalized costs of business, that we still like the company. Is that a fair way to put things? Yeah. Oh, all right. We're in the Q&A. Tell me about this thing. I was going to go there. How do I quantify this? How do I turn this into anything? What is this?
So basically, just like Chris, basically send out a survey to my community. So ages from college students to adults.
Chris has more people we got.
For Chris, he was in Vegas.
I'm kidding.
So what's the end? I don't see the end here.
So basically, the first thing I wanted to get a feel for was just kind of where people thought the market was going to. So that's that first question coming in. Where do you think the market's headed? Do you think a recession's coming? And you see I have an overriding yes. So yes, recession's coming. So that helped with this grocery outlet company. And then the next one was just kind of how people are spending their money.
Where else would you shop?
No, I'm gonna stop getting groceries.
So it's a vibe.
Yeah. All right.
But no, so the next question was just kind of that. How are you going to respond to that recessionary environment? And I think the feel that I got was just kind of take college students who don't really have bills to pay. They haven't really felt. They're still okay with paying that excess in price. Whereas you have adults who have bills to pay, who are working for their money. They're more like, okay, now eggs cost $3. Like, maybe I won't get the eggs. Like, maybe I'll get 6 eggs for 12. Like, so that's kind of, I want to see how it would play into my grocery outlet and them being a discount grocery store.
How might you restructure that question so that you don't get just 100% of the people saying yes?
Maybe the question you just asked would have done it.
Right?
Would you shop at a discount?
Or maybe a slider that maybe ask 3 questions. Do you currently purchase eggs if they're $2 per carton? Would you do it if they were 4? Would you do it if they're 6? Would you do it if they're 8? Right? So, but to the point, we appreciate you're starting to think this way.
Yeah, I love it. It's great.
I can't promise this, but I'd like to say, you know what, I'm very comfortable advocating on behalf of our whole program for. If we all end up liking an approach like this and you want to use it, you all have free Qualtrics accounts. You got 2 people who got PhDs that used it. We know how to test it statistically. There's a wonderful place out there called MTurf that's super cheap to gather some data from. I think we could probably fund some of your work if we keep our costs down.
Yeah.
And you'll be able to collect data from across the country, probably 100, 200, 300 responses. That will
Amazon has a database of
Yeah.
hundreds of thousands of people, maybe millions.
And you don't have to pay much.
No.
And like the kinds of questions you're asking will probably take 30 seconds. You can probably pay 15 cents
Yeah.
per response. And so I'd be a big advocate. I can't promise we'll get it, but I promise I would be happy to advocate on behalf of the program to say we like a funding source for our research. And since you all have access to it, if you want to get a little bit deeper into something like this in your next pitch, talk to us. Like, this is fun. You guys are doing awesome. And if you get the response rates up in the hundreds, like, it doesn't take too many, 100, 200, you'll actually be able to produce statistical significance to your answers as opposed to having kind of like, this is just generally what we found, which means you're actually finding something that is truly provably different than the street. Right. So,
and that will blow away an employer. If you're having a conversation with, Baird managing director, and you say, well, I did a survey to test my thesis, and I got 500 responses, or even 100
yeah, my
responses.
p-val is 0.001 on my response rate, and now I turn that into a quantification. I differ by the street by 3.4 cents.
Yeah, they'd be
like,
right there on the spot.
Yeah, their 20-year analyst would be like, hello, what? Yeah. So my point is, we really appreciate the creativity. This is the stuff we're hoping you guys do, not just this stuff. Grace did stuff everybody did here today, even if you didn't show it. We want you to show it more. We want to refine our approach to kind of quantifying it. Like Chris did. Chris got 2 really great answers that you could have quantified and got himself a home run. And then if we end up liking this in particular, Dr. Valentine and I will help you turn this into something that's a powerhouse if you ever want to try it. Is that a fair point?
Yeah, absolutely.
Any last questions, thoughts, comments? We've been here a long time. We appreciate, now, Grace, we have one last question for her. No, are you still waiting? No, we're teasing.
It's 1 cent per response and 5 cents if you get somebody with a master's.
Well, there you go. So it won't cost us too much is my point to run some of these things.
So I will fund the first few. So
I will
out of my
too.
own pocket. So if we have to, because I really think it's so valuable. That'd be my kind of donation to my
There you go. Same here. So thank you everyone for spending so long. I learned a lot. I hope you did. Those left standing, we appreciate it. Have a great weekend.
Yeah.
Kill the mic.
We got a comment.
Oh, we had a